let's talk about the different kinds of bond yields out there. I want to make it a little more conceptual rather than memorization based, like a lot of people focus on what's called the bond seesaw, but let's understand why it happens and why it works out that way. So first of all, when we start off with what's called the bond's coupon rate or nominal yield, that just stays fixed from when the bond is issued, essentially, right? So bonds are always going to have, whenever they say like an 8% bond, that means that the bond's going to pay you $80 a year, right? $80 a year. And it could be semi-annually, like 40 and 40, or it could be like monthly if it's like a Ginnie Mae pass-through or something like that. So that's going to stay fixed unless it's going to be some kind of adjustable rate or variable rate bonds, or if it's, and then the only other thing, so that's the only way that the bond coupon is ever going to change. I was going to say that generally the par value is going to stay fixed too, except for like tips where the principal value does change based on inflation, not the coupon. So I just kind of want to put that to the side. Unless you have those exceptions, the coupon rate, nominal yield, and par is pretty much going to stay the same most of the time for bonds. And so coupon rate, nominal yield is always going to be based on par value, which is going to be $1,000 for a bond unless stated otherwise, right? So coupon rate or nominal yield, if they say 8% bond, that means it's going to pay $80 because 8% of 1,000 is $80, right? Now it takes us next to what's called current yield. Current yield is just an important formula that needs to be memorized, and it kind of applies to all the exams. SIE 7, 66, 65, right? Maybe other than like the 63, you wouldn't really have to know it there. But of the main exams, that definitely very important. And that formula is going to be the annual coupon over the market price of the bonds. The annual coupon over the market price of the bonds. Now, as you can see, that's going to change based on if the price is going to be a discount or a premium bond. Now, if you just think about math conceptually, right? Like if you have a fraction, the higher the denominator, the lower the number. So for example, a half is greater than a third, is greater than a quarter, is greater than a fifth, and so on and so forth, right? So what does that mean on our context? So a current yield of a discount bond is going to be higher than the current yield of a par bond is going to be higher than the current yield of a premium bond, right? Because if you make up a bond that pays 8% interest, right? So if it's 80 over 960 is going to be higher than 80 over 1,000, which is going to be higher than 80 over 1,200, right? So that's current yield in a nutshell, right? You could always do the math and remember the direction that, the arrows go. Now, with yield to maturity and yield to call, the formula is kind of long and you're not going to be expected to know it for any of the exams, but you can kind of reason this one out conceptually. So, we talked about how nominal coupon rate, that's going to be fixed. Doesn't matter whatever the price of the bond is, right? Current yield is going to be biased towards the discount bonds. Now, yield to maturity includes the fact that it's literally the return you get if you hold a bond to maturity. So at maturity, you're going to get par value of the bond, which is generally going to be 1,000. So now let's just think about it conceptually. You bought something, let's compare all of them. You bought a discount bond for $960 and you get 1,000 back at maturity. So you're making more. You're making an extra $40. You bought a par bond for 1,000. You're going to get 1,000 at the end. Kind of a wash, right? Now, let's say you bought a premium bond for like $1,200, right? And now you're only getting 1,000 back at the end. That's not going to look so nice on the return. Now, you will be getting higher coupons to justify this, but nevertheless, on paper, it's not going to look as nice as if you bought something for $960 and you get 1,000 back. That's why yield to maturity is next in line, right? So you have like for a discount bond, you have coupon rate. That's going to be less than the current yield. That's going to be less than yield to maturity. For a premium bond, it's coupon rate's going to be higher than current yield, higher than yield to maturity because you're getting kind of shafted more and more as you include more factors, right? And the last one, and also just to briefly mention before I forget, with par bonds, it's all the same. So it doesn't really matter because, it's all based on 1,000. So, and then with callable bonds, right? Callable bonds are bonds where the issuer has the right to purchase back the bonds for usually a slight premium after a few years. So let's say they have the right to buy it back for $10.30 instead of $1,000 after 3 years. So let's say that does happen, right? Let's say that does happen. So compare a discount to a premium bond. You bought this bond for $960. You expected to get 1,000 back at maturity, which might be, who knows, 10 years later, right? Instead, you're getting paid back a higher amount in a shorter period of time. You just made out like a bandit, right? That's why yield to call is going to be the highest. So with the discount bond, you have the coupon rate lower than the current yield, lower than yield to maturity, lower than yield to call. Now let's look at a premium bond. You bought this thing for $1,200. You're going to get 1030 3 years later. You expected it to at least play out to get the higher coupons over time to justify the fact that you paid so much for the bond. But you're getting the short end of the stick because you're getting a smaller amount back and you didn't let it play out. So that's why it's going to be the lowest of the premium bonds. That's why when bonds are callable usually and interest rates were to decline substantially, the premium's not going to be that much because everybody knows the issuer is going to call the bond. So what the heck is the point of it trading way higher if everyone knows the issuer is going to call the bond, right? People aren't dumb, right? So that's where the market supply and demand forces come in. So hope that makes sense. Please like and subscribe and listen in for more, and hope you have a fantastic day. Thanks.